hello investors again. This is the second part. I think I forgot to press that live button, so I start talking without anyone being on the other side. Anyway, so this is the second part of Q4 2020 Planet 13 earnings, where we will not hear from the team itself, but I will just go briefly through the numbers and we'll do some analysis in real time. So, without any other, let's go directly to the numbers. Right, so Planet13, they announced the increase in revenue, and of course, you know that in 2020 and in general, there were a lot of days then the facility was closed, and that of course could not impact the revenue. But here's the thing. They just showed that even though Las Vegas was closed in general, there showed an increase 20% in the revenue. Let me just scroll down somewhere here. All right, here. So revenue were 20 million as compared to 16 million. It is an increase of 21.8%. Even though, imagine now if everything was open, everything was like in 2019, I suppose we would see numbers even higher. At this point, when you were listening during that call that just ended like a few minutes ago, I think it was one of the team CEO probably who said that we are frustrated because we have so many people waiting just in lines. They get frustrated and they go to the competitors on the other side of the street. And that just showed that even though there was a 55% decrease in tourism in Las Vegas last year, they still showed 22% increase in revenue. And then they still had a lot of people waiting in lines. Even though if you heard, if you were listening to questions from last QA session in Q3 2020, there is a video, by the way, on my channel that I had separately put it so you can hear the management team and understand why they're brilliant. So anyway, they were discussing this thing, how not to wait, to make people wait in lines and make the experience even more pleasurable. Sorry about my English. And I think that even though one of the main goals is to make you happy as a customer, they still experience so many demand out there. So many people want to be their customers. They still cannot handle it. And now imagine in few years from now, when we have much more people experience Planet13, when Planet13 is open in different states, this will be huge. That's why I keep buying warrants. But let's continue with numbers. Sorry, I probably talked too much. You will probably already, if you didn't want to listen to me talking, you probably already read those numbers. Yes, gross profit before biological adjustments were 7.5 million, or 37% as compared to 57% previously. Net loss of before taxes 1.2 million as compared to net loss of, well, here's the thing. They are still losing money. That's why I say we are not out of the woods yet. So this is not a profitable company yet, but we need to look why it's happening. It's not because they don't have a pretty nice gross margin. No. It's not because they don't have demand. No. They're number one there. They're vertical integrated. They're still on the stage where they are building that company. Therefore, there is a lot of investment coming there. Just take Tesla as an example. They had to invest a lot, and they still do invest a lot. And that's why they're number one. And the company which is number one in the big trend, long-term trend, that is my favorite ones. All right, let's jump straight. I don't want to see those highlights here. You can read them yourself, but probably what's more interesting is to see those numbers compared to last year. And yeah, so profit, loss before taxes, we still see that there is a loss. That's what we just stated here. From 2020 for 3 months and 3 months in December the year before, the loss was even lower than this. But well, that's everything else looks pretty much, well, not really important, I would say. When I was just looking during that call, I saw the few numbers that threw me out. So skipping EBITDA, well, EBITDA, I don't see those lines. 3 months consolidated. All right, December 31. Okay, so the second, third column. Yeah, so it's not even comparable. Again, this was not an ordinary year, so I would take it with a grain of salt, okay? Looking at the revenue, so a company which is growing, I must also look at the revenue, of course. And I already said that 21% increase year over year. That's something really important. Being said that the market was closed for a pretty big amount of time. In the same time, of course, we see that the gross profit here, sorry, the cost of goods sold rose, almost doubled actually. Yes, revenue didn't double, but the cost of sold goods did double. Well, that can be explained that you still have some costs that are not tied directly to the product itself, but some fixed costs there. And that's why gross profit margin was 57% the year before, and now it dropped to 37%. It's still a really nice margin, okay? And when what's interesting there, so the company is still at loss. So I look at those other numbers. Well, marketing, they did less marketing than the year before, which is interesting. They really only had like 30% of the total marketing costs in 2020. Well, it's really hard to compare because we compare like apples with not with apples, but sorry about that. If you want in French, les pommes de terre. We cannot compare 2019 with 2020. And here it is, depreciation. Well, that's not... Okay, so we are still at loss, okay? The loss is around here. Here I find that line. Income loss for the period. So we are around 3 million, which is almost the same loss as the year before. Will a company which grows be sustainable still? Do they have enough cash? That's the question I want to ask. And do they have a current ratio which is more than 1? So in other terms, can their assets, what they owe, cover their liabilities, what they have to pay in this short-term period and long-term period? And let's jump in straight to the balance sheet here. Scrolling down. By the way, if you have questions, since it's live, you can write me and I will take a look at them after I finish, okay? So yeah, here it is, the balance sheet. And here what is outstanding. 2019, 12 million in cash. A year later, 79 million, which is a big increase, okay? We have jumped for total current assets. Everything else didn't change really. It was really that cash. And that cash that we will see later, well, it came from selling warrants, increasing number of shares, and gathering this cash out of the market. Because then, they still have to, spend a few years before they expand, well, big enough, and they have that cash. They're number one, and they can take this market. So if you are going to look what the liabilities are, so total current assets are $90 million, okay? Now, current liabilities, by the way, decreased from 10 million to 6 million, which is good, right? But if you look direct in the numbers, where did it come from? It come from income tax payable. Well, it was 7 million and now it's only 1 million. Well, income tax payable, really, that's something you have to pay anyway. So that's not something they borrowed for short term to expand their operations. Sorry, my language today is not good at all. What I'm trying to say is that we can omit this one. I mean, but still, even if you take this 10 or 6, comparing to 89 or almost $90 million, which means that current ratio is 9, or if you take this number, which we should, it's actually 15, which is just incredible. It means if everything goes as it goes right now, they still have like 15 years they can have this loss, which pretty good enough. I mean, I'm not worried about this company for at least the next couple years, unless their management changed and something crazy happens. That's why this is one of my biggest holdings today. And yeah, so even though we take total liabilities, all the liabilities out there together, and we have in short term $90 million and total liability $30 million, which means even though we're comparing short-term liabilities with total liability, short-term assets with total liabilities, we still have like 3. It's a big index. So for me, financials are fine. That's if you want the short conclusion, I think they're fine right now. That's my personal opinion. But again, I'm not a CPA, not a professional financial guy. I'm just here sitting, like you other retail investors, just educating myself and sharing my education with you. And I pretty like to feel back from you if you know something more than I do. So everything else, not big change. I really thought that those numbers, the current assets cash we have, and how did we do in 2020, shows that in total we are fine. Like we have 15 years to cover. And if you go like EPS, like earning per share, right? It didn't change a lot since last time. It's still the same. For me, it's a good thing, especially take into account what's happened in 2020, which we all know. Now, I think shares based on payments. Now, I just want to find that line here and show you where those proceeds, 70 million, came from. Here it is. So financing activities in the last year, right? So we see that only 5 million was they acquired in 2019. And cash provided by financing activities was only $3.7 million, which pretty light. Now look at this number. In 2020, they raised $75 million, and 33 million came from issuance of shares on warrant and option exercises. 44 million issuance of shares and warrants on financings. So those numbers are to keep in mind. Yeah, so I guess this is it, and this is the end. So just to summarize, I still think this is a really great company. I still think that you should hit that like button and subscribe to the channel. And I think we will see you many more times in the future.